Tesla trades at 50 times earnings while Walmart trades at 25 times. One crashed 65%, the other gained 20%. The price-to-earnings ratio is just stock price divided by earnings per share. If Apple trades at $150 and earned $6 per share, that's a 25 times price-to-earnings ratio, meaning you pay $25 for every $1 of annual profit. Think of it as the price tag on a company's earnings power. But here's where most investors get it completely wrong. High price-to-earnings stocks like Netflix at 35 times seem expensive compared to Ford at 12 times price-to-earnings. But expensive doesn't mean bad. Netflix grew 600% over the past decade while Ford stayed flat. High price-to-earnings often signals growth expectations. Low price-to-earnings suggests mature or struggling businesses. However, this classic thinking misses a crucial third category. Amazon traded at 100 times plus price-to-earnings for years while making investors millionaires. Meanwhile, many cheap 8 times price-to-earnings stocks turned out to be value traps that never recovered. Growth companies reinvest profits, making price-to-earnings ratios artificially high. Declining companies may show low price-to-earnings ratios right before earnings collapse. But there's an even bigger price-to-earnings trap that catches experienced investors. Myth: lower price-to-earnings always means better value. Reality: a stock trading at 5 times price-to-earnings might be cheap for good reason, dying industry, accounting issues, or one-time earnings spikes. Enron had a reasonable price-to-earnings before collapsing. Cyclical stocks show artificially low price-to-earnings ratios at peak earnings, right before they crash. Smart investors know there's one final price-to-earnings secret that changes everything. Most beginners only look at trailing price-to-earnings based on last year's earnings. Professional investors focus on forward price-to-earnings using next year's projected earnings. A stock might trade at 30 times trailing price-to-earnings but only 15 times forward price-to-earnings if earnings are expected to double. This explains why expensive growth stocks often outperform cheap value stocks. The key is knowing which price-to-earnings number actually matters for your investment timeline. Remember, price-to-earnings ratios are tools, not rules. High price-to-earnings can signal opportunity or danger, just like low price-to-earnings. Context matters more than the number itself. Ready to master advanced stock analysis? Visit nexusAIcalls.com for professional-grade market insights that go beyond basic ratios. Subscribe if this helped you see price-to-earnings ratios differently.